Hi everybody, my name is Griffin Bridgers. I want to welcome you back to part 2 of the basics of the generation skipping transfer tax. So in part 1, I introduced the tax and introduced some of the basic definitions that are going to drive the ship. And in today's presentation, we're going to dive into two of those specific definitions and some of the nuances that go along with those, specifically the transferor and the skip person. Now, as always, I want to remind you that this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. Quick note, I will have a Google form in the notes for this video, so if you're interested, I'd love to get a sense of who you are and why you're listening, so if you could take the time to fill that out, I would greatly appreciate it. So, jumping back to the purpose of this series, it's designed to teach the basics of generation skipping transfer tax to private wealth professionals, be it attorneys, wealth advisors, trust officers, CPAs, anybody who deals with intergenerational transfers of wealth. Now, as I mentioned in part 1, this series is going to assume you know the following basics. One is the calculation of estate tax and its associated deductions and credits. The other is the calculation of gift tax and its associated exclusions, deductions, and credits. You'll see kind of why as we jump off with our intro to the definition of transferor today. So, to get maximum value, I suggest you be familiar with gift and estate taxes first, and I also suggest that you listen to these parts sequentially. So before you listen to this part, listen to part 1. Now, last time in part 1, if you'd listened, we learned that the GST tax can apply anytime there's a transfer that is defined under Code Section 2601 as a generation skipping transfer. And Code Section 2611 goes on to define generation skipping transfer as being one of the following categories of transfer, which we haven't learned yet, but will. Those will include a direct skip, a taxable termination, and a taxable distribution. But before we can even analyze whether we have one of those types of transfers, we need to understand the definitions of transferor and skip person. Those are people who sit on opposite sides of a gift transfer or a transfer that's not by sale. So much like you might have donor and donee for a gift, you might have decedent and heir for a transfer at death. Well, we're going to have transferor and skip person being on both sides. So again, we looked at the illustration of how the GST tax works in the various generations we're walking through. And without a GST tax, as we recall, we could save estate taxes of $21 million and change by simply making a direct transfer from Generation 1 to Generation 3 and skipping intentionally the living members of Generation 2. But the GST tax fills in to say even though there's no estate tax here technically, there is an additional GST tax. So, our illustration of what we're going to learn today is that we have the transferor, in that case, the parents transferring $100 million in wealth, and then generations 3, the grandkids who are receiving wealth net of an estate tax and potentially a GST tax. So, to know the definitions, we have to start with the transferor. That's the person who's in the older generation or older than the recipient who's making a transfer. So we're always looking at transferor technically being older either by generation assignment or by age difference. However, we define transfer as being a direct transfer of property, but it could also include a situation where either the property is included in taxable gifts with respect to that transferor or included in the gross estate of that transferor. As we're going to see later, we'll look at this a little more, but in Code Section 2652A, we learn that the concept of transferor can be fluid, and there can be some special rules, like for Q-tip trusts, that we will cover later. But for the time being, I think it's important to note that there are some examples that go beyond a mere direct transfer of property to a skip person potentially. So, for example, you might have a situation where you have a transferor who isn't necessarily the person who creates the trust, but they might be the trustee of a trust and also a beneficiary. And in that role as trustee/beneficiary, they have the unlimited discretion to make distributions of income and principal to themselves. That's a bad power, because what that means is that even though the trustee isn't the technical owner of the property for tax purposes, in this case, since they can personally benefit, they have a general power of appointment over the trust. Remember where I said it helps to know some of the estate and gift tax basic principles? Well, this is where we're really going to come into play on some of those items. But in either case, what we can tell by the facts here is this trustee/beneficiary has a general power of appointment. And if they die holding that power, they could be subject to estate tax not only on their assets, but also the assets of this trust. So they decide to relinquish the power by resigning as trustee, but they stay on as a beneficiary. But guess what? In this situation, that release of trustee power could be treated as a gift by the trustee/beneficiary to the other trust beneficiaries, and thus would be included in that trustee's taxable gifts for the year of release. So the end result is that even though the trustee/beneficiary wasn't the person who funded this trust, they become a transferor for GST tax purposes without actually making a transfer, because the trust property was included in their taxable gifts for the year. So the transferor can shift. Same thing might happen when the trustee/beneficiary dies while holding that trustee power. They're treated as holding a general power of appointment at death, which means that trust property, as I mentioned earlier, is included in their gross estate. Thus, the now deceased trustee/beneficiary becomes the new transferor of this trust by virtue of the assets being included in their gross estate. What we're going to learn is every time the transferor changes this way, is that it wipes the slate clean in terms of any prior use of GST tax exemption and creates a new assignment of GST tax exemption by the new transferor. So the big takeaway here is that the definition of transferor can shift, and that really somebody could put property into a trust and be the original transferor, but later this intervening tax event within the trust can cause another person to thus have the trust property included in their taxable gifts or gross estate, creating a new transferor and shifting that definition and that identity from the original transferor to the trust to this new person. And as I mentioned, that shift will be a brand new generation skipping transfer if and when it does occur. So in the next part, we're going to dive into the categories of generation skipping transfer: the direct skip, the taxable termination, and the taxable distribution. But for the time being, now that we've looked at transferor and how that definition is fluid, we also have to have a skip person on the other side of a transfer of wealth. So the transferor is transferring property to a person who, if they're categorized as a skip person, will close the loop on this being a generation skipping transfer that could be subject to the GST tax. So typically you have to have at least one recipient on the other side who's a skip person. I say a recipient or one recipient because later we're going to look at trusts that might have many current and potential beneficiaries in multiple generations, and what we're going to see is that the mere presence of one skip person, living or even future born, could create a generation skipping transfer to that trust at that time. So in that context, we're going to look at a skip person in one of two ways. One, generation assignment. If an individual recipient of a wealth transfer is a descendant of the transferor's grandparent, then we look at the difference in generations. Are they two or more generations younger than the transferor? If so, by generation assignment, they'll be a skip person. If they're not a descendant of the transferor's grandparent, then we can look to the difference in age only. And if that recipient is more than 37 and a half years younger than the transferor in that case, that's a bit of a typo on the slide, it should say than the transferor, then that recipient will be a skip person as well. So that's a little bit confusing. So the visual may not be as easy to follow as you think, but we really kind of take this table of consanguinity, which shows degrees of relationship, and we divide it in two. So down here on the far left, we have a red box. That's the transferor, who we've already defined. So looking across all these relationships, we have to figure out who would be a skip person. Now I've drawn a line where we get past grandparents, because on the left side of the red line, these are descendants of the grandparents, and in that part of this chart, all we care about is generation assignment. We want to see somebody who is 2 or more generations younger than the transferor by generation assignment, not necessarily by age. So in that case, you start with the transferor, go down 2 generations, and everybody in that generation of grandchildren or lower, or grandnieces and nephews or lower, or first cousins twice removed or lower, will be a skip person solely by generation assignment. If you're not on the left side of the red line, or if you're not related to the transferor at all, then you look solely to the age difference. So anybody in the yellow boxes or anywhere on the right side of the red line, if they are 37 and a half years younger than the transferor, they will be skip persons regardless of generation assignment. So hopefully that kind of gives you a visual to break this down. Now, as with anything, the tax code is complicated, and there are special rules that I think are helpful to know. One, what if you're dealing with a spouse? So a spouse or a former spouse of the transferor themselves is never a skip person regardless of age difference. So even if you marry somebody much younger than you, they will never be a skip person with respect to transfers made from you to them. However, getting beyond the transferor, if the spouse instead is married to a skip person and is the recipient of property, they're assigned to the same generation as the skip person, regardless of age difference, if we're dealing in the left side of this table of consanguinity over here. In all other cases, we deal with the age difference between the spouse of somebody and the transferor. I also want to highlight that a trust itself can be defined as a skip person if the only current and potential beneficiaries are skip persons. Now, moving beyond that, what if you have somebody who's adopted or maybe is a half relation? Adopted persons are treated as blood relationships with respect to the transferor if you're on the left side of the table of consanguinity over here. So anybody on the left side, if they're adopted, is still potentially a skip person. Also, half-blood relationships are treated as whole-blood relationships as well. So once again, that would really kind of apply on the left side of the red line over here, where if you have somebody who by marriage or is a stepchild or step-grandchild or has a half relationship to the transferor, they will still be subject to this table and generation assignment when determining whether they are a skip person. Now, if you thought that was confusing, we've had 2 layers of complexity so far, but there's one more layer of complexity to dive into, and that's the deceased parent skip rule found in Code Section 2651E. And the spirit of this rule kind of helps you, I think, or at least it helps me to understand it a bit better. Because way back at the beginning of this course, I mentioned that the GST tax is designed to tax transfers that intentionally skip generations. So I highlight that word intentionally because that's where this deceased parent rule comes in. Because sometimes, if you have a skip person whose parent is deceased, there's no intentional skipping of that parent's generation if the parent isn't living. So if you have a parent who is a descendant of the transferor, and that parent is a deceased, then the descendant of that parent and each of their descendants moves up 1 generation, and thus they may cease to be a skip person because they cease to be assigned to a generation that's 2 or more generations younger than the transferor. Now that applies to direct descendants and is easy to tell, but for collateral heirs who are descendants of the transferor's grandparents but not the transferor themselves, they could also move up 1 generation under this rule, but only if their parent is deceased and the transferor has no living descendants. Now, once again, I think it's helpful to go to a visual here. The only time we're going to be dealing with that rule under Code Section 2651E is, once again, if we're on the left side of this red line dealing with descendants of grandparents. So in this case, if we look at the transferor on the far left, if we take out a member of the generation of children, that first generation, what that means is that all others under them, the descendants, will move up one generation. In other words, the descendants of that deceased child move up one generation, and in that case, the grandchildren would cease to be skip persons with respect to the transferor, but the great-grandchildren still would be. But in that case, the difference is we're not intentionally skipping a living member of that first generation. We have no choice but to leave property directly to the grandchildren if we're providing for our blood descendants. Now, if we move on from that, we also see everybody below nieces and nephews or first cousins once removed. If you have a member of those generations X'd out in that generation 1 of nieces and nephews and first cousins, then their descendants could move up one generation as well, but only if the transferor has no living descendants themselves. So once again, in that case, there'd be no intentional skipping of generations and no intentional skipping of your own descendants. So it naturally creates a transfer to those potential skip persons by generation assignment who get the benefit of moving up one generation. So lots of nuance to the definitions of transferor and skip person, but if you can master those definitions, that's the key to being able to determine when there is a generation skipping transfer, and thus when the generation skipping transfer tax might apply. Stay tuned for part 3, and in the meantime, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But thank you again for listening to this part 2 of Basics of GST Tax, and I look forward to seeing you in the next part.